A month ago, 30-year-old Sam Bankman-Fried was once a powerful figure in Los Angeles and went by the initials SBF. Based on Bloomberg's estimations, he was worth over $15.6 billion and ran a trading firm named Alameda Research, in addition to operating a cryptocurrency exchange under the name FTX. Looking at the present, the cryptocurrency billionaire went from industry hero to villain in the span of a week, losing the bulk of his fortune and watching his $32 billion firm tumble into bankruptcy. Not only that, but he was also the focus of investigations by the SEC and the DOJ. The sudden loss of the crypto billionaire's riches begs the question, how did this happen? In this video, we're gonna try and figure that one out. Hey folks, we're glad you're joining us today on Econify to take a look at the story of a guy fallen from a billionaire's grace, Sam Bankman-Fried, and how it all happened. You don't want to miss it. Hit like and subscribe for all of our videos and feel free to stay till the end of this one. Now then, let's see what we got here, shall we? The FTX company, founded by the billionaire crypto entrepreneur, has certainly attracted a lot of media interest. In less than 4 years, this son of 2 law professors rose to prominence as a leading figure in the cryptocurrency industry. His ambitions included disrupting the established financial system. But now, only his initials and maybe $100,000 in the bank are all that remains of his former life. John J. Ray III, an attorney who assisted creditors in recovering billions of dollars following the bankruptcy of energy trading firm Enron, was named FTX's new CEO on November 11. They also announced on that same day the resignation of Bankman. FTX and Alameda Research are just 2 of the roughly 130 companies in this sector that have sought Chapter 11 bankruptcy protection, making an already bleak outlook even worse. Problems in the FTX market are currently to blame. Mr. Bankman's crypto empire crumbled after a run on investments left his cryptocurrency exchange FTX with an $8 billion deficit, forcing the company to file for bankruptcy, also due to liquidation fears. Before the fall, he had been compared to financial tycoons like JP Morgan as well as Warren Buffett. It's looking pretty grim because the fallout has had a wide impact, threatening the stability of other crypto companies as well as sowing widespread fear and mistrust of the technology. The 30-year-old Bankman-Fried has been relatively quiet in the media over the past week, but he has recently expressed many regrets about FTX's demise. As the cryptocurrency market continued to slide in the wake of the Terra Luna collapse way back in May, Bankman-Fried went on a buying spree. On the Dealbook Summit, FTX announced its intention to acquire a lot of companies, including Alameda, from which it had borrowed substantial sums. The ex-billionaire stated his belief that all lines of credit to various borrowing desks have been repaid by the bankrupt trading firm. Still, the firm continues to owe Block 5 more than $680 million, according to court documents. Caroline Ellison, the former CEO of Alameda Research, had claimed that the firm utilized money from FTX customers to pay for loans that were being recalled after the collapse of Luna. Funny thing is, it seems like it was only Ellison, our ex-billionaire, and another insider. Bankman-Fried, on the other hand, said he was aware of Alameda's loan but didn't realize how much it was, and he admits that the loan's prospective losses were quite big. That being said, he was unwilling to elaborate on the more pressing issues surrounding him, including whether or not FTX inappropriately utilized billions of dollars in customer assets to prop up a trading firm he had created named Alameda Research. And now the SEC and the Department of Justice are looking into the nature of that connection. Things are looking pretty bleak from this end, but who knows? While Bankman did not disagree with critics in the cryptocurrency industry who suggested he had spread himself too thin, Alameda had amassed a big margin position on FTX, which means it had borrowed funds from the exchange. And he blamed his lack of attention to FTX's problems on his other responsibilities. You really gotta feel sorry for the poor guy, don't you? The crypto community was caught off guard by the fall of billionaire Bankman-Fried, but in recent months, red flags showed up indicating that his economic empire was in danger for a long time, and that his objectives were too great for his current level of success and abilities. So exactly how did SBF fall from grace? He embarked on a spending spree this year, putting money into floundering cryptocurrency companies, but he didn't tell any of his key staff. He ignored warnings that he was too busy and refused to employ more help. What's even funnier is that while in Washington, he was attacking Changpeng Zhao, CEO of competing exchange Binance, for using his massive Twitter account to create a run on FTX and lobbying for a strict regulatory agenda. Despite receiving millions from a variety of venture capital firms, FTX has had no outside investors serving on its board. And 4 sources familiar with the matter have said that Mr. Bankman-Fried, while in the Bahamas, mostly kept to himself, but also did spend time with a close group of co-workers, some of who were in a thing with other FTX employees. Billionaires do love to live big, so why not splash the cash? He and his senior employees lived in a penthouse in Albany, a 600-acre oceanside resort on New Providence in the Bahamas. You could say that Fried's involvement and engagement with Alameda and FTX caused his fall from billionaire status. Looking at how he began, you got a feel for the guy. As the son of 2 Stanford law professors, he decided to create his own trading firm in 2017 and move its offices to Berkeley, California, close to his childhood home. The company amassed millions of dollars rapidly by taking advantage of flaws in the Bitcoin market. Because of the more business-friendly rules in Hong Kong, Bankman decided to move his company there in 2019. He did this with a few other traders, most notably Caroline Ellison, a veteran trader at financial firm Jane Street. He relocated and then launched FTX, a marketplace where crypto investors may buy, sell, and store digital assets. Connections between FTX and Alameda were strong. And critics of the FTX platform claim that there was a conflict of interest since Alameda made money off of the losses of other clients, despite the fact that it was a heavy trader on the platform. Mr. Bankman-Fried, however, defended the arrangement, arguing that Alameda's liquidity injections were critical in facilitating the trading activities of other customers. Now, what's he saying about the lost investments? Bankman-Fried has insisted that the funds in customers' cryptocurrency accounts on FTX have never been used for investments. He maintained that FTX never used account funds in this fashion. Later on, though, he did admit that his other company, Alameda, had borrowed significantly more funds from FTX's balance sheet for investments than he was aware of. You might be wondering, why didn't Bankman see what was happening, all the red flags popping up before it was too late? No one really knows, my friends, but life has a tendency of sneaking up on you at any given moment. Bankman freely admitted that he botched up big a lot of times. He still argues, though, that a lot of trouble might have been averted if FTX hadn't filed for bankruptcy, which largely put financial concerns out of his hands. His constant refrain was that the company's upper management was actively trying to destroy the business because they felt so much guilt about its past. Bankman maintains that he should have continued in his effort to raise more money, and that had he done so, withdrawals would be opening up in a month with clients entirely whole. Even if that were a possibility, new money would still need to be negotiated with FTX's creditors and approved by the bankruptcy court. The last question would be, what's in it for Sam Bankman-Fried? For one thing, using customer funds to perpetually stabilize the price of FTX's own FTT coin could be used as evidence that FTX breached its fiduciary obligation in the eyes of the prosecution. Regardless, Bankman maintains he was unaware of any fraudulent action on behalf of the company. But there's more. The U.S. Department of Justice is likely to seek criminal charges, even though executives associated with FTX face potential exposure on numerous fronts due to the availability of class actions. According to the Wall Street Journal, both the Department of Justice and the Securities and Exchange Commission are looking into the FTX collapse and are in constant communication with one another. And you know what that means? Double trouble. Criminal and civil investigations can progress concurrently with this kind of cooperation between authorities, and information can be gathered more efficiently. So that brings us to the end of a real-life horror story. It's pretty sad to see such young talent fall so far down, but have we seen the last of SBF? Maybe, maybe not. Time will tell. What do you think? Let us know in the comment section down below. If you missed it at the start of the video, our like and subscribe button's right there for you to get more content like this. See you in the next video, folks. Take care and thanks for watching.